Hello students, today we will discuss investment, process and avenues of investment. Cash is not an investment. If you have surplus cash with you and if you keep that cash with you only and not investing anywhere, you will not get any amount as a return. Moreover, the value of that cash may be reduced. For example, if you have 100 rupees with you and you are going to purchase an item with that 100 rupees today, and after 1 year you are using the same 100 rupees for buying the same product, that cannot be possible, because the time value of money will be reduced in the coming future. So, you must invest that particular cash with any investment opportunities that gives you some return. Today we will discuss on investment, its meaning, its basic features, its factors affecting investment, the difference among investment, speculation and gambling, and best investment avenues in the current scenario, and last the process of the investment or investment cycle. The term investment means the action or process of deploying money in profitable opportunities. In an economic sense, an investment is the purchase of goods that are not consumed today but are used in the future to create wealth. But in finance, investment is a monetary asset and it is purchased with the idea that the assets will provide income in the future or will later be sold at a higher price and which result a profit. So, you are investing and expecting some return in the form of profit or capital appreciation. So, we can say that invest is to allocate money in the expectation of some benefit in future. The growth of the economy depends on the capital formation process, which is dependent on the amount invested by the household sector or industries or private sector, etc. Therefore, every country tries to provide a favorable environment to promote investment. Likewise, an individual sacrifices his present consumption to generate savings, and these savings they invest in various assets to generate income. So, investment refers to employment of savings to earn income or return. Every investor expects a rate of return which is higher than the inflation rate. Investment can be defined as a commitment of funds that is expected to generate additional money. It may also be described as a mechanism into which funds are placed with the expectation of higher returns than inflation. So, an investor who buys shares of a company expects dividend and capital appreciation of his investment. Dividend means when a person invests his amount in shares, he will get that return in the form of dividend. When he invests in debentures of a company, he expects a fixed interest stream during the holding period. Similarly, when an individual purchases some immovable assets like house or in real estate, he earns capital gain when he transfers his assets, and also he can earn a rental income. So, what are the basic features of investment? The basic features of investment includes there is a commitment of funds. Commitment of fund means we have a savings, the surplus of our money is known as savings. So, there is a commitment of funds and there is an expectation of higher earning. There is a commitment of fund and there is an expectation of higher earning, and there is also a basic feature. The basic feature is that there is always some risk involved in that investment. There is a risk also while investing an amount in an asset. So, these are the basic features, and then we move to the various factors which affecting investment. According to Keynes, the investors are depending more upon the business expectations. These business expectations are very uncertain and volatile. This is because the prospective yield of capital asset, they may change quickly and drastically in response to the general mood of the business community, or based on the rumors, or based on the news of technical developments, or because of the political events. Sometimes even the director's decision may cause a sudden rise or fall of the expected rate of yield. So, we can discuss one by one the major factors influencing investment, and these factors include liquid assets, political climate, level of income, anticipation of future requirements, risk tolerance, income level, tax liability, total wealth, investment time horizon, liquidity payment, etc. These are the major factors which influence an investment. So, first point is liquid asset. The amount of liquid assets with the investors influence the inducement to invest. If they possess large liquid assets, the inducement to invest is high. Liquid asset means we can convert that asset into cash within a short period of time, that is liquid assets. This is especially the case with those firms which keep large reserve fund and undistributed profits. On the contrary, the inducement to invest is low for investors having little liquid assets. The next point which affect, that is political climate. See the case of Afghan. Today, recently the US vacated in Afghan. The people in Afghan is not ready to invest their amount there because of the political uncertainty. The neighboring country is also not ready to invest any amount in that country. So, the political climate is a major factor which affect investment. So, if there is a political instability in the country, the inducement to invest may be affected adversely. In the struggle of power, the rival parties may create unrest through wholesale trade union activities and thus creating uncertainty in business. On the other hand, a stable government creates confidence in the business community, whereby the inducement to invest is high. The next point is level of income. If the level of income rises in the economy through rise in money, wage rates and other factor prices, the demand for goods will rise, which will in turn raise the inducement to invest. On the other hand, the inducement to invest will fall with the lowering of income levels. The next point is anticipation of future requirements. We all need homes, or sometimes we need amount for the education of our children. So, anticipation of future requirements is also a factor. So, identification and anticipation of the short term and long term goals influences the investment. This may include funding the education for children, investing in business, or for the expansion of our business, or for any retirement or for housing activities, etc. So, investors can directly address the requirements by identifying these goals with the investment. The next point is risk tolerance. How much risk can you tolerate in the long run? Thus, understanding the risk factor is one of the major keys for choosing an investment scheme. The risk tolerance may differ for every investors, maybe based on their age, the mindset of the present age, and the emotional makeup also largely impact the ability to tolerate risk. The next point is income level. The absolute income level as well as return requirements will largely affect decisions relating to investment. Investors' income can also influence the risk preference. Investors with a higher income may be more inclined towards riskier strategies because they have a higher income and they can conveniently contribute to added investment capital when they face any losses. The next point is a tax liability. Individuals' tax or any special tax circumstances are a few considerations that will help you to determine ways to seek the maximum utilization from your tax benefiting investment schemes. For getting a tax deduction, sometimes they may invest in some securities or in provident fund which will gives you tax deduction. The next point is total wealth. Total wealth is also a factor. The value of a person's expected pension or his other retirement benefits may influence the return objectives and the risk tolerance of his investment portfolio. Moreover, our wealth levels can also impact the way we live. The next point is investment time horizon. Investment time horizon is also a factor which affects the investment. And this point, that is investment time horizon, require us to ask questions such as when do you plan to draw the assets in your portfolio? Do you prefer to choose short term or long term maturity assets? Do you have enough time for recovering from a descending market? How important is capital preservation for meeting an urgent financial need? So, all these points will be reflect in our investment. Next point is liquidity payment. Liquidity means can be converted into cash within a short period of time. So, this is about the ease with which you can transform your asset into cash at or near to the latest fair market value. This may require us to ask questions such as, do we need an investment portfolio to liquidity or can we wait some more time? And here liquid assets include cash in hand, cash at bank, fixed deposits and liquid funds. Fixed deposit means for a short period of time, we can invest our entire money for a longer period of time or for a shorter period of time. And there are some differences between investment and speculation. Investment and speculations are two terms which are different from each other. Investment is defined as the employment of funds to acquire certain assets after due diligence for medium to long time period with the objective of wealth creation and additional income in future. But in speculative investment, it may be defined as the employment of funds to acquire assets for shorter duration of time to take advantages of fluctuation in prices of underlying assets. If you are trading with the shares in the stock market, there are some traders, they are known as speculators. Sometimes they may be investor also. So, investment and speculation are two terms. There is another term which is gambling. Gambling is differ from investment. It means the employment of funds for entertainment or fun, and in that situation there is a chance of return. which will depend upon probability of certain situation or events. That is for example, deploying funds on horse racing or card playing, etc., that can be termed as gambling. So, speculation and gambling are different from investment. Speculation and gambling are the two different actions used to increase wealth. Gambling refers to putting money in an event that has an uncertain outcome with the expectation of winning more money, whereas speculation involves taking calculated risk in an uncertain outcome. So, there are various differences between investment, speculation and gambling. In investment, our own funds are used for investment purpose. So, a person having surplus money can invest their money, but in speculation, own fund or borrowed money may be used for speculative purpose. But in gambling, we have a good wealth and we are using that for fun. And in the case of investment, we are investing the money for a long period of time. But in the case of speculation, it is a short term nature, and in gambling, it is for an immediate time horizon. The other difference is on a risk. In the case of investment, risk is very low, but in the case of speculation, risk is very high. Higher risk is in the case of speculation. In the case of gambling also, there is high risk, and most of the people doing this for just for their fun or for getting some entertainment only. In the case of return also, we can get a good return in the case of investment, but maybe low return compared to the speculative activities and gambling. In gambling and speculation, we will get higher return, but there is a high risk. So, these are the basic difference among investment, speculation and gambling. So, next we will discuss the various investment avenues. There are various avenues. We can invest our money in real estate, or we can use for purchasing commodities, or for some debt instruments, or can use our fund for purchasing equity shares, and there are various investment avenues. And at the time of purchasing an equity share, we will get a return in the form of dividend, and in the case of debt instrument, we will get the return in the form of interest. And in the case of real estate, if we invest our money in real estate, we will get capital appreciation, but not in the immediate future. Sometimes they may take much more time, but the return may be high. So, there are various investment avenues. We can select based on our risk tolerance or other factors which we discussed earlier, and the return may be higher or lower based on the investment avenues. So, the next point is best investment avenues in the current scenario. We discussed the investment avenues, and in current scenario, the best avenue is equity capital. In equity capital, the risk is very high. At that time, we can use another investment avenue, which is mutual fund. In mutual fund also, it includes equity capital. So, there are various type of mutual fund, equity based mutual fund, debt based mutual fund, or balanced mutual funds are also there. So, we can select any of the investment which is based on, or in that investment includes equity shares, and the return may be very high. Or we can invest the amount in employee provident fund, or can invest our amount in bond, or in real estate, or in foreign overseas mutual fund. So, all these are good investment avenues. We can investment we can invest our savings or surplus money. So, investing in securities such as shares and debentures is profitable, but at the same time it involves a greater deal of risk. It is rare to find investors investing in their entire savings in a single security. Instead, they invest in a group of securities. So, we can diversify our risk. So, such a group of securities is called portfolio. So, an investor who understands the fundamental principles and analytical aspects of portfolio has a better chance of success. The last point we discussed today is the process of investment or the investment cycle. It includes developing investment policy, investment valuation, investment analysis, valuation of securities and portfolio construction. So, the first point is investment policy. This is the first stage in the investment process. In this stage, the investor has to decide the investable wealth and portfolio objective. The investor has to identify the potential investment assets and attributes of investment assets. Allocation of the wealth to the assets categories is one of the most important consideration to be taken at this stage. After that, the next stage is investment valuation, and valuation is the heart of any investment decision. It means whether that decision is to buy or sell or hold an asset. So, a rational investor should have a firm understanding of the proper valuation techniques, the financial structure of the companies, the prospectus or the future of that company or future earnings, the market value of shares, earning per share, book value of shares, past trends in prices and demand and supply of that product of that company are taken into account while valuing financial asset. Then we must analyze investment. So, investment analysis. When an investor has arranged a logical order of the type of investment that should be included in the portfolio, the next step is to analyze the securities for the investment. So, the investor must take a comparative analysis of the type of industry, financial strength of the company, kind of security means a fixed asset or variable securities. After that, we must value each securities, and this is the fourth step. In this step, we will value each securities. Valuation includes comparing the present worth of the assets with the future benefit. So, comparison of the value with the current market price of the assets allows a determination of the relative attractiveness of the assets. Each assets must be valued on its individual merit, and finally, the portfolio should be constructed. In portfolio construction, portfolio means a group of securities. Portfolio construction requires knowledge of the different aspects of the securities. Portfolio construction must be based on its safety, its growth, its liquidity, and the selection of investment, its allocation of savings, a determination of diversification level and investment timing. After that, in last stage, we will take a feedback of this portfolio. If we need a change, we can change the portfolio based on the current situation. So, these are the points which are an investor should take into consideration at the time of making an investment in any investment avenues. Thank you.